Qualified purchaser. It's a designation that separates the financial elite from the rest. But what exactly does it mean, and why does it matter? That's what we're going to dive into today. And welcome back to the channel, folks. I'm Dave Seymour, and today we're unraveling the mystery of the qualified purchaser. This video is for aspiring investors looking to understand the landscape of high finance, or for those simply curious about how the financial world works behind the scenes. So let's dive in, do a little demystifying of this important concept. At its core, the term qualified purchaser is a legal designation created by the Securities and Exchange Commission, the SEC, under the Investment Company Act of 1940. Don't let that dry legal language fool you. This designation has significant implications in investing. Think of it as a VIP pass to the most exclusive investment clubs. Qualified purchasers get access to investment opportunities that are off limits to most investors. We're talking about things like certain hedge funds, private equity funds, venture capital funds, other sophisticated investment vehicles. Before we get into the nitty-gritty of what these opportunities look like, let's tackle the big question. What does it take to become a qualified purchaser? The SEC has set specific criteria for qualified purchasers, and they're not for the faint of heart. Here are the main ways that you can qualify. 1. An individual or family-owned business that owns $5 million or more in investments. Note that these are investments, not total assets. Your primary residence or business property doesn't count. Number 2. A trust not formed for the specific purpose of making the investment, which is sponsored by and managed by qualified purchasers. Number 3. Any person acting for their own account or accounts of other qualified purchasers who owns and invests at least $25 million in investments. Any company that owns and invests at least $25 million in investments and that is owned directly or indirectly by 2 or more natural persons who are related, such as siblings or spouses, including former spouses, or direct lineal descendants by birth or adoption, spouses of such persons, the estates of such persons, or foundations, charitable organizations, or trusts established by or for the benefit of such persons. Now, let's take a break and we'll break this down. For individuals, the key number to remember is $5 million in investments. This doesn't include your home, car, or business assets. We're talking about your investment portfolio, stocks, bonds, mutual funds, and other securities. The bar is set even higher for institutions and companies at $25 million in investments. This could include pension funds, endowments, or large family offices. It's worth noting that being a qualified purchaser differs from being an accredited investor, which is another important designation in the investment world. While the accredited investor status opens some doors, the qualified purchaser status kicks them wide open. But why does this designation exist? What's the purpose behind it? Well, the qualified purchaser designation was created as part of a regulatory framework to protect everyday investors while allowing more sophisticated investors access to complex, potentially riskier investment opportunities. The idea is that individuals or entities with this level of wealth and investment experience have the financial cushion to absorb potential losses from high-risk investments. It believes they have the sophistication to understand and evaluate complex investment strategies, and also the resources to conduct thorough due diligence or hire professionals to do so. In other words, the SEC assumes that if you have $5 million or more to invest, you either know what you're doing or can afford to hire someone who does. Now let's talk about what being a qualified purchaser actually means in practice. What doors does this designation open? Well, the primary benefit of being a qualified purchaser is access to certain investment funds exempt from many regulations that govern mutual funds and other publicly available investments. These are often referred to as 3-C7 funds, named after the section of the Investment Company Act that allows for their creation. These funds can employ sophisticated and often riskier investment strategies that aren't allowed in funds available to the general public. They might use high levels of leverage, invest in illiquid assets, or use complex derivatives. Some of the types of funds that might require qualified purchaser status include hedge funds. These are actively managed funds that generate returns by using advanced investment strategies like short selling, leverage, and derivatives. Private equity funds. These funds invest directly in private companies, often taking controlling stakes and actively managing the companies to increase their value. Venture capital funds. Similar to private equity, but focused on early stage, high potential growth companies. Real estate opportunity funds. These funds might invest in large scale real estate development projects or distressed properties. Specialized investment vehicles. These could be funds set up to invest in specific assets like art, collectibles, or even things like life insurance policies. The potential upside of these investments can be significant. They offer the possibility of returns that outperform the public markets. They can also provide diversification benefits, as their performance may not correlate closely with stock and bond markets. However, as always, it's crucial to understand that with potential higher returns comes higher risk. These funds often have less liquidity, meaning you can't easily cash out your investment. Use complex strategies that can be difficult to understand, and they have less regulatory oversight and potentially less transparency. They may also charge higher fees than traditional investment funds. It's also worth noting that being a qualified purchaser doesn't automatically make these investments a good idea. It simply means you're allowed to invest in them. The investor or their advisors still must conduct thorough due diligence and understand what risks are involved. Now, even if you're not in this rarefied group, shall we say, understanding the concept of qualified purchasers is valuable for several reasons. Number one, it provides insight into how the investment world is structured with different levels of access based on wealth and sophistication. Number two, it highlights the importance of investor protection regulations. The existence of these designations highlights why it's crucial to understand your own risk tolerance and investment knowledge. Number three, it can serve as a long-term financial goal. While $5 million in investable assets is out of reach for many, it's not impossible with disciplined saving and investing over time. Number four, it emphasizes the value of financial education. The more you understand about investing, the better equipped you'll be to make sound financial decisions regardless of your net worth. And moreover, while you might not have access to 3C7 funds, there are still plenty of sophisticated investment strategies available to non-qualified purchasers. Many hedge fund-like strategies are now available through publicly traded funds. The rise of alternative investments and democratized finance platforms have also opened up new opportunities for smaller investors. So there you have it, the world of qualified purchasers demystified. This designation opens doors to exclusive investment opportunities, but it also comes with significant responsibilities and risks. Remember, being a qualified purchaser isn't necessarily a goal to aspire to for its own sake. The most important thing is to make informed investment decisions based on your own financial situation, goals, and risk tolerance. Now, whether you're a qualified purchaser or not, the key to successful investing remains the same. Educate yourself, understand your investments, diversify your portfolio, and always be aware of the risks you're taking on. Covered a lot of ground today, and we'd love to hear from you and hear your thoughts. Does the concept of qualified purchases surprise you? What did you think about the idea of different levels of investment access based on wealth? Let us know in the comments below. If you found the video helpful, please give it a thumbs up, subscribe to our channel for more insights on investing and personal finance. And don't forget to hit the notification bell so you never miss an upload. Until next time, here's to growing your wealth and your financial knowledge.